Alright, everybody, we are live. Let's roll. Thank you for joining me. We got some slides here on the show, and we're gonna go ahead and just close out of this coin position, like, right now. Never mind. That's what I expected to see. I was like, oh, damn, if we're profitable here, yeah, we're out. This is okay, you know. Coin high IVR, we expected that this move may potentially happen. Bit of a short-term trade, and I may actually just, you know, if we're profitable, I was thinking about this position, and it's not exactly ideal, you know, because we kind of need coin to go our way relatively quickly here, but we are going to be able to reduce our cost basis significantly to about 2% and turn this into a 20-wide debit spread. So at the end of this, we'll probably be left with just a larger than normal debit spread. I may actually go ahead and change things up even a little further, just so that we have some insurance here. That's about 4K buying power. That's a little thin. We might change this up, and yeah, that's about 10% for 10% CVAR. What if we 289? Yeah, that's about 10% right there. So now we basically will have a built-in ratio spread. We'll reduce our cost basis even further, and here in the next couple days, we're really going to start to see the profit balloon on this position. If coin, you know, goes down a moderate amount, we can see some nice returns here. So I think we will go ahead and just gingerly add to this position. See if we get a fill here around 320. It is a little risky because now we basically have a built-in ratio spread. But I just was thinking about this trade last night, and I don't like how the cost sets up. So now we have something really interesting here if we unpack it a little bit. And let me know how the music sounds, guys. Definitely still new to the whole streaming aspect of it. But I'll unpack this coin trade here in a minute, and then we'll get into the slides once we kind of do the State of the Union portfolio overview. We'll go ahead and just bump that down a little bit, and probably pull the stream up in another window, because I am still working off one monitor here, so appreciate you guys bearing with me here as I continue to learn and grow. But yeah, so this coin trade. This was a diagonal that we put on yesterday, and I was feeling kind of lukewarm about it, and ultimately decided that, you know, we can add this short put here. So now we have the 185, 165 diagonal spread. Plenty of short theta working for us here, positive theta, I should say, taking the short side of the contract. And I just, you know, if we take a look at this diagonal spread here in isolation, right, what do we have? So this actually, okay, good. So this doesn't include the put that we just put on. So we'll get an increasing amount of profit here as time goes on, just due to the nature of the diagonal spread. If we go to today, you'll see that the 9-day option will continue to decay for us. We'll hit max profit around our short strike for the diagonal spread, and then of course, at that time, we will probably start eating away into the 130 put here. So the ideal move for coin is to the downside, but not too much to the downside. And of course, we did pay a hefty price for this 185 put here. If that continues to go out of the money, we can always reduce our cost basis by rolling this to the, you know, the 35-day expiration cycle. So not too worried about that. You know, if we go in here and we check out, let's say we roll this, right? So this is 8 days to go. If we roll this 165, if we buy back the 165 and we sell it in the 36-day cycle, the 165 right here, we still collect about $6. So we're going to reduce our cost basis significantly from about 17 to about 11. And then, of course, by 36 days to go, we'll have a better understanding of how this trade is going to shake out. So this is a bearish move in the short term for coin. But other than that, the rest of the portfolio, peachy here, especially Dell and Micron, positions that we sorely needed to go the other direction, doing so now, and happy to see that. We will get into the rest of the portfolio here shortly, but I'm happy to see that VST earnings were a nothing burger. VST just struggling to find ground here, which, you know, like I said, I'm okay with. The IV crush, we're feeling the love from here. 172 Tesla. We'll get to Tesla here in a minute because that's going to be the focus of the content. Of course, our Q and ARM shorts are down today, but the rest of the portfolio doing exceptionally here with this rally that we're observing, and we are continuing to be bullish in the short term. I probably will flip to bearish in early 2025, but I mean, look at this massive comeback from ES here. So if we just go to the daily chart, we're on the 1 hour chart right now, but you can see that upswing. We'll go month to date. Actually, we'll just zoom out to like 2 months. Yeah, so, we had the correction. Looks like we are recovering from the correction shortly, but still sort of contested here at the 52.75 mark. The 200 EMA for ES obviously touched during the correction, and hopefully we hold this here. But I have no guarantees, of course, that we're going to remain bullish. So happy to take the IB crush. I believe if we look at the VIX, it has to be down today. Yes, it is. Down 225 to 2350. And doing well, all things considered, portfolio wide. Of course we're losing in coin. That's totally cool. We have short premium to take advantage of the high IB rank here. We've got a short put at 130, and we've got the diagonal spread. So, for you savvy traders out there, you might basically consider this a staggered ratio spread, right? If you do a ratio spread as a 2x1 or 1x2, you're buying one and then selling two in the same expiration. We're doing something a little different. We are essentially turning our diagonal spread into a shitty ratio spread, pretty much. In that, the move against us has already happened. We still, of course, want coin to go down to 165 to capitalize on this diagonal spread. But, that's going to hurt our 130 short put. So if we could snap our fingers and control the price action of coin, we would want Coinbase to go to 165, stay there for 8 days, drop down to 130, and then we could capitalize on the full value of this 185 put here. But of course, we can't control the price action, so we're going to just rely on short theta instead. So we're, going to chip away here. Our cost basis, of course, allegedly, 17.05 on this spread, and then you can minus 3 because we've collected $3. So we paid $21.88, then collected $4.83, and then collected an additional $3.05 on top of that. So the 17.05 is just for this portion of the spread. Things are getting kind of complicated here, so I may actually just customize this and just call this, here we go. Yeah, so this is actually the accurate cost right now. With the short put, we've actually only paid $14, and then we can roll, this. We just group this as, I don't know, we'll call this messed up ratio spread. Yeah, so we've only actually paid 14, and we will be able to roll this 8 DTE option out in time to 36 DTE to further reduce basis. Basically paying for the right to, be somewhat protected if Coinbase continues to drop. Of course, that's contingent on Bitcoin, and you know what? If this trade totally fails, we got the rest of the portfolio to totally carry us here. AMD still not within that 135 range. Let's just back up. I'm going pretty fast, and I'm all over the place. ARM's going to be down today. We got the short call. It is what it is. Coin, we've pretty much beat to death. But, yep, that's Coinbase. If we lose the other $2 here over the next couple days, we'll roll this out. And we can even potentially roll it up if we want to just, collect more premium. A lot of flexibility here with these varying expirations, which I really like, and they're all within 45 DTE. So, gonna get a lot of theta decay here. Still gonna end up, again, paying about 2% of the account as it stands, but we can reduce that by rolling this 8 data expiration 165 put out in time. Qs, we're down on for the day, but still pretty healthy overall for a naked call. We're going to continue to keep this Q position on even as it struggles because the rest of our portfolio is so bullish. Tesla, I promise we'll get into the slides here in a minute, but you know, we're 135 leap, doing great. Our short call at 250 also doing fine, and we're still well within the original trade in terms of in the moneyness. So happy that we made the leap adjustment. We'll get into all that here in a second. VST we touched on. The custom view of this actually makes things look a lot better than they are. This is the order chain overall. So we'll go ahead and just look at the order chain, take the red pill in the matrix here, do a little bit more truth searing. So yeah, VST doing just fine. Should be pretty smooth sailing here if we can get up to 75, between 75 and 85. We've got to hold that for a while, but earnings are out of the way, and that's one less thing we got to deal with. Amazon, short put, market up, enough said. CrowdStrike, same deal, short put, market up, so we're profitable. XBI. XBI, we're just going to keep rolling it. We're only $1 away from our short call strike and our 94-102 inversion. Things go south, we can just roll it out again. I got no problem rolling this to the end of the year, especially because it's in an index. Silver, sort of the same story. We're bullish on it. Been rolling a straddle for a few months now, and still, you know, doing fine. 25 and then 60 cents actually puts us at 24.40 or thereabout for break even. So happy to sit tight there. AMD not yet untesting our 135 short put, so we're still deep in the money there. Happy to keep that 165 call on in the meantime. Micron and Dell pretty much bringing the portfolio up here, and Palo Alto up to 310. This 350 call very quickly going to expire, worthless here in about 15 days, and if Palo Alto's at 350, I am going to be celebrating. So that's the state of the union. Healthy for the portfolio overall, where we got to be up at least 1%, even with the Coinbase shenanigans that we're currently dealing with. Look at that. Wow, 30% profit chance. So yeah, this 185, not looking too good in terms of profitability, but we'll have that short premium ticking away at us. So let's go ahead, not delay any further. Let's get into the slides for today. And I'll just go ahead and switch us over. So today I just wanted to talk about leap options. So here we are, and in particular I'm going to be discussing this Tesla trade. We're going to take it apart and discuss why I decided to roll my tested short put into a leap option massively far into the future, instead of sticking with the patented 45 DTE theta curve. So for those of you who are totally new to the show and don't know what a leap option is, a leap option is options that are just dated farther out in time. That's all they are. They're just long dated options. Options that are usually 90 days or more to expiration. So, and LEAP, by the way, stands for long-term equity anticipation. The name is actually pretty telling. Pretty much just means that investors are anticipating long-term movements in stock prices. So typically, if you're an option writer, if you are taking the short side of the contract, if you are selling to open, typically option writers avoid leaps because of the tasty trade mechanics. And I'll have some links here to some tasty trade research and basic reading about leaps if you want to go further with this. But usually, option sellers avoid leaps because we can just go to 45 DTE and we have more theta than you typically would. And I'll show you all this with some graphics here in a minute. But just understand, if you're writing an option, it's far more preferable usually to stay in the 45 DTE cycle where you have that theta curve, you've got the theta acceleration, and you have more theta overall. However, with all that said, leaps are an alternative to an option writer. If you have a position that's been tested and you don't want to invert a strangle and you don't want to move your short strike in, leaps are an interesting alternative that I've been experimenting with, especially if you've already rolled a position outside of that 45 DTE curve. So we'll look at an example here in a minute, but I've been combining leaps with 45 DTE options to sort of give my position a little bit more solidity, and we'll see here in a minute why that's beneficial to me, I think, or beneficial to option writers in general. But again, none of this is backed by backtesting and stuff like that. I just took the tastytrade mechanics, and all we're doing is just making observations. So, and from this is my claim that leap options can, in the right circumstances, be a useful alternative to traders maybe not willing to invert on a tested position. So we'll see that here in a minute. Here is an example of just an option that I pulled up on the order chain. This isn't a position that I have. This is, I think, in Tesla. I just wanted to demonstrate what a leap option would look like, and I used the 71 DTE cycle because it's the same cycle that our example will come from. But here is the 71 DTE option. That's the shorter dated option, the option that is approaching the 45 DTE theta curve, and then you've got the 180 strike put, so the same strike, same option type, different expiration, 862 days, December 18th, 2026. So you'll notice here by the numbers, if you're writing the option, right? Actually, let's back up. So the way I like to dissect the short side of the contract is to think about what the long side wants. If you're long these puts, you're actually short delta. So if you are buying this 180 put back and selling the 180 put in a further expiration, you'll pick up more negative delta because that put is going to have less bullish effect for the seller. So it's a little bit of a backwards gymnastical move that you have to make with your mind, but I'll share the specifics here in a minute. You're going to lose theta, right? That's what we talked about on the first slide. Your longer dated option, your leap, is going to have less theta than your shorter dated option. So you're going to lose theta, you're going to lose time decay, which is the big drawback, right? And that's why we try to avoid leaps in the first place. But in exchange for that, you're going to gain a ton of extrinsic value. And in this case, because they're the same strike, because you're rolling out in time and exposing yourself to more potential move, your buying power effect is going to increase. I think this is on Tesla. I failed to capture the symbol. But key differences. You're losing theta, you're picking up extrinsic value, and in this case, you're picking up credits. And you have, as the short seller, remember, if you're short a put, you're bullish delta. So the fact that you're -3 delta here is actually pushing you closer to neutral in terms of directional risk. So, this is an example where I'm rolling a leap option to farther out of the money strike, and this is actually on AMD, so I'll go into the platform and I'll demo this here. But just understand, it's almost the same principle. You have less theta, you have extrinsic value, you're still routing this for a credit, so you're de-risking, you're adding extrinsic value, you're losing theta, which is not good, but you have a significant delta reduction here, which is good for the short side because it reduces your directional risk. You're also gaining buying power. You're reclaiming buying power, which of course is helpful because any capital that you're able to reclaim is capital that you can use elsewhere, right? So let's go into the platform and I'll show you. So because I think just getting your hands dirty and getting out of theory is worth its weight in gold on any account. So here is an AMD position that has been tested, right? Our 135 put has been breached, and I'll actually show you this on the curve view. Here's our 135 put where we're obligated to buy AMD. AMD is at 129, and we also have a short 165 call. So our profit range is going to be between 165 and 135 plus our credits received, which you can see here. We're obligated to buy AMD at 135, and we're obligated to sell AMD we don't have at 165. So we want AMD between these two short strikes. AMD at 130 is not the ideal spot for it to be. However, we could, if we wanted to, we could move this short call strike in closer to the money. On big moving stocks, though, that presents whipsaw risk. Right? So in this case, with our AMD position, I've collected 462, 562, 582, 583, and you can see that here on the order chain. So having collected 583, we're right at about the break even for this position. and I'm tempted to make an adjustment, but we have 43 days left in the cycle. The AMD IB rank is still quite high, so I'm going to sit tight. I'm not going to adjust this any further for the reason that we are right at about that break even, and I want to give AMD some more time to come back to us. However, getting back to the content for today, we could, alternatively, if AMD continues to go against us, look at rolling this 135 option out into a leap. Now again, we are inside the 45 DTE curve, so ideally we want to let this option sit here. If, however, we're comfortable sacrificing that 45 DTE theta curve, we can go to any of these leaps down here. And let's take a look at what happens if we roll this leap to the 135. So same strike, excuse me, we're rolling the 45 DTE option to a leap option. So same strike, way out in time. You'll notice we're going to be short 15 deltas here. The delta on this option is 40, and the delta on our current option is 56. So we are actually reducing directional risk here for the short term, which we'll get to in a minute. But just understand that just by rolling out in time, you're reducing your directional risk immediately. We are sacrificing a large portion of theta and the theta decay, which is not that great, and we're picking up a huge chunk of extrinsic value. So now AMD, by the gray bar here, has to go way down here for us to be in any jeopardy. Here's where things get really interesting. If I take this guy and I yank him all the way to where we don't get a credit anymore, so this is a debit, we'd pay to do this, we receive a credit here, which is good. As option sellers, we always want that. Now our directional risk has been greatly reduced by 36 deltas. We're still losing theta, but not nearly an amount of consequence that's different than here. Minus 8.3, minus 8.7, big deal. What's the big difference? You still lose 8 theta no matter what. We are able to reclaim some buying power. We pick up some extrinsic value. We pick up some credits. Those are all great things as an option seller, and we've significantly reduced our directional risk. Also, take a look at the probability of profit here. 62% probability of profit versus 64%. So the market is saying that we're actually more likely to stay profitable if we stay in the 45 DTE cycle, which is worth noting. So hopefully that gives you some insight as to why rolling to a leap isn't the greatest idea when you're already in the 45 DTE cycle, because we're sacrificing all this theta. Yes, we are reclaiming some buying power, and we're neutralizing our directional risk, but we're giving up all that theta, and in the 45 DTE cycle, we want to stay here if we can. Here's where things get really interesting. I told you guys at the beginning of the slide that, leaps can be attractive if you're outside the 45 DTE cycle, so let's take a look at this Tesla trade. It's kind of messy. It's a messed up earnings trade, but just take a look at this here. So we had the 72 DTE 200 put, and we rolled that to the 135 put at 863 days. So notice, at 72 days to go, we're outside of the 45 DTE curve, and we're in the money. So I'll just go ahead, and because we did this yesterday, so we had the 200. We're buying the 200. And we sold a leap for 135. So notice at the 200 strike, at 72 days to go, we're in the money. The stock is and was in the money prior to today, because it's up $1.94, so we were at 191 or thereabouts, and we're rolling it to the 135 all the way out here, which is what we did, right? Well, take a look at this. The probabilities of profits now, since we were outside of the 45 DTE curve, had changed. So, if we're short the 200, we only have a 57% chance of being profitable. If we roll out in time to the leap option at 135, we have a 61% chance of being profitable and an 86% P50. So, the 135 leap, 61% probability profit, 86% probability P50. The 71 DTE 200 option, which again, remember, is outside of the theta curve, 57% probability profit, 72% P50. So we're boosting our P50 and probability profit massively by taking this in the money, out of the 45 DTE expiration option and rolling it all the way out in time. Why? Because at 71 DTE, you're already kind of on the border between the 45 DTE option and a leap option. Leaps are typically 90 days or more. So at 71, you're actually closer to 90 days to go than you are 45. And at that point, rolling, you know, you're not quite at the theta decay curve yet. So in this particular instance, it was actually kind of a smart move, I think, to roll that option out in time, especially because I don't mind owning Tesla, especially at a lower price. So we had a shattered earnings trade. We had a 200 strike put that we, 210 strike put that we rolled to the 200 in the 74 DTE cycle. So we had a short put that was tested. We bought it back in the 25 DTE cycle, rolled it out in time, collected a credit for doing so, and then rolled it out even farther as a leap option. So the big takeaway here, if you guys don't take away anything else, is that rolling farther dated options that are outside of the 45 DTE curve seem to be beneficial. Based on the P50s and based on what I've observed, that seems to be the case. Now, obviously, you know, I haven't backtested this, and I don't have any hard research to back this up, but I'm simply referring to the niche case where you've got options outside of the 45 DTE cycle that are already tested. Rolling those to a leap seems to be pretty beneficial because you're reclaiming buying power, you're increasing your probability of profit, and you are reducing your directional risk. So I'll show you one more time just because... let me see if I can find... Okay, CrowdStrike is another great example. We're not tested here, but again, you know, if we took this CrowdStrike guy and we rolled him to way out here. So the brokerage, you know, it says meh, you know, that's not really that less... You're not really reducing your risk that much because you're actually, if anything, you're increasing your exposure to large moves in a stock like that. But if we yank this guy way down, and again, we're not tested, so we don't have to do this. Look, now the brokerage is like, oh, well, we like that. We'll give you some buying power back. And interestingly, it has a probability of profit of less than 1. It's just because we are buying back. It's probably the platform. We haven't actually been tested yet on this 200. So again, there would be no reason to do this here, but I just want to demonstrate that you do tend to get buying power back when you roll down in the case of a put, and out. Out meaning to a farther expiration. So, that's all I got on leaps so far, but again, just the takeaway here, you're decreasing your buying power, you have decreased theta, you're increasing extrinsic value and credits received, and the main point here is that you get a significant delta reduction when rolling out in time. So, one other thing I'll show you here is that when you combine leaps with 45 DTE options, you get some really interesting effects. The leap option anchors, quote-unquote, the position, and what I mean by anchors is that the position deltas are still governed by the leap option. So take a look here. You've got a short 135 put that's a leap. It's got about 20 long delta, and you've got this short 250 call on Tesla. This is actually my Tesla position in the 45 DTE cycle. So as you get closer to expiration in the 45 DTE cycle, charm is going to kick in and the delta is going to become absolute. It's going to become either 100 or 0. Because remember, at expiration, options are either worth something or they're worth nothing. So this delta here is going to decrease. And I remember Tony Batista actually saying to Katie in the early days of the platform that this delta is not real. And what he means is that this delta is subject to change. It's going to change to 100 or 0 at expiration, but right now it's just a theoretical delta that will change with time. Because 862 days is significantly farther than 43 days, this delta is not going to change as much. That 20 delta is going to remain more consistent and it's not going to decay to 0 or increase as quickly to 100 because there's still a lot of uncertainty left in this time frame. And if you want to read more about this, go look up Charm, which is the delta decay. It's how quickly delta, decays basically to 0 as time continues on. So as you get closer to expiration, you've got delta governing the option less and less, and then gamma actually kicking in closer to expiration. But in the meantime, Charm's going to kick in and decay that delta because Charm is the delta rate of change. So all this to say, this -9 delta is going to get closer and closer to 0. So it's going to go from -9 to -8 to -7. It's not going to follow that exact mathematical decay, but that negative number is going to become closer to 0 as time progresses, meaning that our absolute deltas on this position are going to increase. Right now, as of this screenshot, we had about 10 absolute deltas, 10 and change. As time progresses, this 10 is going to increase. We're going to have more directional exposure, which is why I mentioned here that it's the short-term deltas that are neutralized. Remember when I said in the beginning of the presentation that rolling out into a leap can reduce short-term exposure? Yeah, that's true. You are going to pick up more bearish deltas by rolling to a leap, but because you have the 45 DTE options introduced, which do not have as persistent deltas, you're actually going to increase your exposure gradually. So that can be a good thing if you're still directional on the underlying stock. And I'll show you what I mean here. If we go to the analysis tab, so in the case of Tesla, theoretically, yeah, we have about 7 deltas here, and we're not gonna really be negative delta till about 204 today. If Tesla gets to 204, then we're officially short. Here's what's interesting though. As we fast forward time, you can see this graph, it's shifting to the, oh, sorry, I didn't switch the presentation here. So I'm gonna do that. Good information. Thank you, Timber Haynes. Appreciate it. Thanks for joining the stream, by the way. So let's go back into the platform, which I totally forgot to switch over. But if we go to today, right, you can see here that your deltas are at about 3. If we just fast forward, and let's just say we've had the power to Thanos Tesla, you know, we just froze it, and we put it at 194.50. As we fast forward through time, remember that short 145 call we have is going to lose delta because of Charm, and because it's more certain that that will end up out of the money. Because of that, your delta here is going to actually increase. So you see here we have 10 delta. If we fast forward even further, now we have 14 delta, and the max profit is closer and closer to that short call. So it's you can kind of think of the leaps. The image I have in my head is like a tourniquet, right? It will stop the immediate short-term ramifications and actually help you out in the short term. But the longer you kind of leave this going, the less protection it's going to give you. And in some cases, it can actually hurt you. If you fast forward all the way to expiration, where, you know, this short call is out of the money now and it's totally worthless, right? When this short call expires, you still have all the downside risk you did before, and your exposure to the downside or to whatever side you're rolling has actually increased. At, you know, 812 days to go, we have 15 deltas versus the 3 deltas we have now. So leaps are a good, they're a nice short-term relief, and they can reclaim some buying power. And I kind of am experimenting with this alternative to inverting or rolling the short untested side closer in, particularly only with options that are already outside of the 45 DTE curve. Remember, you want to stay in 45 DTE for all the reasons that we listed. If we just take a look at AMD again, you want to stay here, right? We don't want to take this 135 that's in the 45 DTE cycle, and, you know, if we kick this guy out to, you know, 862 days, probability profit 51% versus the 65% probability profit that we have in the 45 DT cycle. But I'd wager that the 135 day in 71, if my observations hold true, we buy this back. Actually, I mean, if we're short this, right? That's a 59%, 80% P50, 55%, and 81%. So not too much difference there. Versus, you know, very clearly giving up profitability in the 45 DTE cycle. So, and again, theta is the main driver here, right? We're still getting plenty of theta decay on that 135 put option in the 45 DTE cycle, and AMD actually, as of this conversation now, is pretty much within our break-even point. So now we're really feeling good about this trade because we got five and change dollars, and we're only $3 in the money. So if AMD just continues right where it left off, we're not going to have very many problems at all. So that's the long and short of my experimentation on leaps and what I've observed there, which is mainly just that if you have a position that is outside the 45 DTA theta curve, the leap seems to help you out in the short term, and this gets really potent when combined with the power of the 45 DTE cycle. So leaps by themselves can be a nice ejection mechanism, and the other main thing here, you are giving up theta, but you're not exposing yourself to whipsaw risk as much. For example, here we got plenty of room for Tesla to go ahead and rally to 250 if it wants to. If we followed the traditional means of just moving this untested side in, then we're left with a short option that's outside of the theta curve, and another short option that's inside of the theta curve but pretty close to the money. So here, the gambit is that we are keeping that 45 DT option as far away from the money as possible, and instead of sacrificing profitability, we're sacrificing the theta curve on our tested side, de-risking by rolling that way out in time, rolling it out of the money, and pretty much just keeping these options as far out of the money as possible, so that we don't get whipsawed. In this case, we actually bought ourselves a lot of room from 200 to 250 now to 135 to 250. So if we look at the expirational profit, it doesn't look encouraging because it's taking into account the leap option and how far this is yet to go, but you know, it is what it is. There's trade-offs everywhere, and I think, like I said, for options that are outside of this 45 DT curve, which we were at 74, you're already bordering on leap territory, and I think embracing the benefits of the leap seems to be okay. I have yet to actually have that theory tested mathematically, so like I said, you know, take this all with a grain of salt. It's really just my observations at this point that are driving this, and just the numerical differentials between the options as I kind of play around with it. But that's something interesting that I noted, and yeah, this coin trade is really suffering here at 329, but here in about another dollar, this 165 will be worthless, and we'll be able to roll this out again, pick up some more long deltas. We are going to lose some theta, but we're cool to let this sit. We knew this was going to happen, and it's all right. You know, we're paying the man on this long 185, but look, I mean, we've already got this down to 17. We're going to get it down to about 1,000 and have access to a 20-point wide debit spread, which is really powerful. The worst case scenario, of course, is that Coinbase, you know, if it just tanks. Because if it goes down to just 123, that's no good either. Our max loss here, capped at 1,400. Our max loss to the downside, unlimited, essentially. Not unlimited because, you know, stocks can only stop at 0. But, yeah, so, you know, the profit graph here, again, showing a little bit of red because we kind of adjusted this a little bit more, but I just wasn't feeling that great about the diagonal. But, you know, if you take a look, right now we're down about 300, if you just wait a few days, we just fast forward to about here, we're gonna go down to about 2:30. So time is still very much working for us, and we'll continue to do that until about August 19th, August 20th, when we have that short put expired, the weekend goes, and then we don't have that extra theta decay. But like I said, we can roll that out in time and keep that theta working for us. Happy to have a bearish position here, a couple bearish positions in the portfolio when we are still so overwhelmingly bullish. Palo Alto, look at that, $9, and yeah, this 350 call, will it get threatened? I mean, if Palo Alto gets to 350 in 15 days, I'm having at least 6 margaritas, man, because that's gonna be a fun one. We're gonna get to roll that out for a bunch of credit, and this looks bad, but like I said, we got 15 days. This thing's got to go $35. Very well could do that, go being up 10 today, but I'd much rather Palo Alto be up than down with 90 deltas or so on the positions. So, excuse me, just 1 second. Okay, great. American Airlines, look at that. We're just gonna keep rolling this guy. See if it can make a comeback. Silver doing well. Pretty much everything except our short positions doing well today. To be expected with this NASDAQ move of about 180. 1.82, sorry, up 300 points. So, yeah, we'll just, we'll hold tight. It's, I don't think I have privacy mode on, so I won't show my account details here, but, hope you guys enjoyed that. I know I was kind of all over the place with that presentation, but I'm hopeful that, you have some indicator of how to actually digest leaps and maybe some good experimental things to try. Like I said, mostly an experiment for me, taking options that are outside of that 45 DTE curve, tested options, and using the benefits of leaps to not only get them out of the money, but to give myself some shorter term directional relief, especially when combined with 45 DTE options. And the beautiful thing about this Tesla position, for example, is let's say we get the rally in Tesla that we want. Let's say we wait a few days, we'll just fast forward a couple weeks. Let's say we get to 212, 220, and we fast forward really to expiration. We can take that 250 call and we can sell another call farther up, while still having that short put there to kind of anchor the position. So the flexibility with the 45 DTE option is also something that I wouldn't shy away from. But that's all I have for you guys today. Just some interesting info on leaps that I observed when I was trying to dissect this Tesla trade, and let me know, if that sort of made sense at all, or if there's something else you want me to clarify. I'm actually interested in backtesting this, so I am probably going to go into the backtester and maybe play around with the profitability of leaps over time, just to give myself some mathematical assurance that my intuition is correct. But yeah. Anyway, I'll see you guys at the market close. Thanks for listening, and I'll see you soon. Peace.